Hi, and hello, wherever you are. Welcome to current liabilities. Disclaimer and copyright notice. The information and opinions of this presentations are those of the author only and not the author's employers or affiliated organizations, including but not limited to the South Orange County Community College District or the South Orange County Community College District or Chapman University. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2019 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. So we're going to talk today about current liabilities. And what exactly is a current liability? Well, the current liability is, and we kind of saw this previously, is anything that's due within 1 year of the balance sheet date. And the kinds that we've already seen to date that we've seen in other chapters has been, or I should say in other presentations, and if you want to go back and kind of take a look at those, basically when we were doing accrual entries, or essentially how do we go through and make adjusting entries. So if you want to go back and take a look at those videos, you can see them. There's unearned revenue. What's unearned revenue? We've received the cash, but we have not yet performed the services. Accounts receivable, accounts payable, sorry. We've received the goods or services, but we have not paid for them. Notes payable. These are generally used to finance certain types of purchases like equipment, and will include an interest rate. A lot of times students will ask me what the difference is between a note payable and a loan payable. Oftentimes it can be depending upon state law. If you're going to try to securitize the equipment that you're selling in case the buyer defaults, you would do it under a note. A loan is generally going to be something that is, cash. Basically, you're giving somebody cash and or you're receiving cash and you'll be paying them back the principal amount plus interest within that year. Interest payable, that relates to the loan. Interest payable usually comes about that I've received the benefit of having that money, but I have not yet paid for the interest. And then you have over here, customer advances and deposits. So if I'm Tesla and the customers are giving me money for future cars to be delivered, let's see here, give you an example. I'm going to pause it real quick. So here we have Tesla, and this is for their September 30th, 2019 quarterly report. They have here customer deposits. Now, the $665 million is generally going to be for advances they've received for future vehicles. Deferred revenue, which is right here, is more than likely if a customer has prepaid for certain services, or if Tesla has received money, but they have yet to perform the service obligation or basically a hardware upgrade. That's the difference. They're both liabilities. However, there's like different nuances here, which is in terms of what exactly is it. So when I go ahead and here look at other current liabilities, so this part over here, so I've got the other types of liabilities that we have not yet explored. Is one of them is dividends payable. Where exactly does this come about? Well, when we get to study the equity chapters, what we're going to see is when I pay, or when the kind of the mechanics of a dividend is when a dividend is declared, I have to record the corresponding liability. And that's generally going to be a current liability because it'll have to be paid within the year. Sales taxes payable. Okay, this is how we help our state of California. If I am a retailer, right, and I'm saying if I'm selling a vehicle, okay, so if I'm a retailer, I'm selling a vehicle, what's going to happen is I'm going to basically record that vehicle sale. I'm going to basically debit cash, and I'm going to credit sales revenue. Also, though, that's going to be included in that cash is that I, as the dealer, I have to collect the sales taxes relating to that sale. So I'm going to go to that, buyer, my customer, and not only are they going to be paying the purchase price, they're also going to be paying the sales taxes. Those sales taxes are not for me to keep. So what I'm going to end up doing is that I'm going to have to remit those sales taxes to the state of California. So again, sales taxes payable, I've collected the cash from the customer, right? But I have not yet remitted that to the appropriate state agency. One thing to keep in mind is that you have to know whether or not, if you're selling items, whether or not tax should be paid or sales taxes should be paid. The reason why you need to make sure you understand whether or not sales taxes should be paid is essentially because if you are a merchant and you're selling an item and it later is determined that you should have been collecting sales taxes from your customers, you will have to be personally responsible to make up that tax difference. So that's really why it's important, is when you're starting up a business, you need to make sure you have that part of it in order, right? You need to know whether or not your business has, or basically is required to pay sales taxes. Okay. Income taxes payable, a little bit different than sales taxes. Sales taxes are on the gross amount of what's being sold. Income taxes are my net income. And for income taxes, I'm basically going to have both federal and state. Okay, you can also have foreign income taxes payable. Again, it just really depends upon the item. And there's even more complicated things when it comes to income taxes payable. However, we're going to leave those for intermediate accounting. Okay, so one of the other things about current liabilities are payroll liabilities. And the reason why I'm spending a little bit of time here talking about them is that when you are working as a financial executive or a financial officer, right, you can have a personal liability if you collect sales taxes from a person, but you fail to report, or you fail to remit those taxes that you withheld to the federal or the state government. There is personal liability. So be very, very careful to make sure you understand that. Over here, when you're looking at federal and state withholdings for employees, you have FICA, which is called the Federal Income Contribution Act, another word for Social Security, Medi or Medicare, SDI. This is not Strategic Defense Initiative. If you're in the state of California, it is something called State Disability Insurance. And at the same time, as an employer, when I withhold Social Security from an employee, or I withhold Medicare, I am also responsible to contribute on behalf of that employee those same dollar amounts. There can also be other withholdings. If an employee comes in, they have child support dues, union dues, all those kinds of things, those can also be withheld from the paycheck. So let's just kind of take an example of this really quickly. So we're going to go up here. And so, okay. So we've got over here, T is paid a wage of $40 per hour and works 30 hours in a week. Okay, so the gross wage, and if any of you have received a paycheck, you'll see the gross amount of the wage right here. Then you're gonna have less the withholdings, okay? Now, FICA, right, which is the Federal Income Contribution Act for the employee, that's gonna be 6.2% of the first X dollar amount in wages. You have to look at what those limits are. Medicare, 1.45% unlimited. So if you make $1 million, you're going to be paying 1.45% of that in basically to the federal government. Federal withholding. This is something that as an employee, you make an election. I think it's done on a form W-4, where you're basically going to go through and say, hey, federal government or employer, please withhold these amounts from my paycheck. Same as over here with your state withholding. Okay, so again, I'm using rates here of 25% and 9%. And then you have California state disability insurance. So although I made $1,200, $512 was withheld by my employer relating to this. So as an employee, I'm getting $688. Now, in terms of how this is actually recorded as a journal entry. Now, for my classes, I don't cover this. I'm just making you sure. I want to kind of make sure that for you, you understand kind of how this works. mechanically. So if I'm doing a journal entry for this, I'm going to debit salaries and wages expense. I credit cash for the amount that I am paying the employee because they're going to get a check. And then over here, I'm going to have payroll liabilities. Why is this a liability? Because generally when I'm doing these types of withholdings, right, I'm not going to be paying them to the state agency or the federal agency immediately. It might be at the end of the month. Over here, though, at the same time, right, is this all I need to pay for on behalf of this employee is the $1,200? And the answer is no. I also have to make a FICA contribution for the same amount. So if I'm withholding 6.2% of wages as an employer, I also have to pay in $74 for that employee. Same thing here is with Medicare. You also have other taxes as well, employee training tax, unemployment insurance. So right over here, I'm going to have on behalf of this employee, I'm going to be debiting salaries and wages expense. This is for the employer portion of the payroll liabilities. Then I'm going to go over here and credit payroll liabilities. One of the things I just kind of want to really mention to you, and this is just really important as you're going out and you're going to be starting your own business, is you really want to go through and you want to use ADP or Paychex or whoever else. You do not really want to be doing this on your own. And it's just one of those things. It's easier to have a third party do it. You ship them the cash, they do the work, and then you give them the money. They're kind of on the hook for all that stuff. There's some great agencies that do it. And part of the reason why I always say this is because of personal liability. I was working for a company as a controller, and within the first week of starting, the CEO of the company informed me that he was not going to be paying the withholding taxes for those employees. And so I said, I thank you very much. I'm not going to be working for you anymore. So you have personal liability if a company withholds amounts from employees' paychecks, but does not give that to the appropriate state authority. So again, you want to be really careful about who you are working for, because remember, as the CFO or the controller or anything else, you're going to be blamed for everything. Okay. The other costs of employees, do I have to offer them health insurance? The answer is sure. Or actually depends on the state and if I'm a small or large employer. Workers' compensation insurance, if you ever go to a Costco, take a look at their break room. If it's visible from outside of the store, you'll see a big sign that says number of days without an accident. And then you have employment practices liability insurance, which is really used for things like sexual harassment, age discrimination. Those are items to go through and to protect the employer if one of their employees goes rogue. Now, one of the things you're going to be seeing as an employee is that there's a lot of training about sensitivity, about using different types of terminology. As an accounting instructor in my classroom, I am very, very careful in terms of what and how I just say different things. Why I could be sued, right? As an instructor, I generally I treat everybody the same. I've been doing that my entire life. And hey, have fun, right? That's really what this is all about. You know, go out and have a great time. I really don't care where somebody comes from or their background. Money is green. And my goal is to teach you as to how to account for it. So there you go. Another kind of this thing to kind of really think about here is in terms of payroll liabilities is when it comes to independent contractors. Now, one of the things that you're probably hearing about in the news is that with the state of California, with Lyft and Uber, they are trying to go through and say, wait a second, these are not independent contractors, these are employees. If you're in a business that has independent contractors, you need to make sure you are satisfying the IRS's requirements. And the reason for that is because if the IRS or if the state of California later comes back and says, wait a second, this independent contractor that's doing this work for you is really an employee, then that government agency then looks at what you paid that independent contractor as the net wage, meaning that as an employer, you're going to be responsible for not only the employer payroll taxes, but for all of those other withholdings. So again, be very, very careful when it comes to this area. You need to make sure you have the right human resources assistance for you going forward. Do not pretend. I'm an attorney and a CPA, and I don't even look at HR issues. I'm going to send those over to Ann Laguza or some other professionals that I know. And that's just the way it works. Okay. You have to make sure you have the right human resources professionals working for you at your company, because if you don't, you're just looking for an absolute nightmare, especially in the states such as California, where this video presentation is being made. Okay. Another type of contingent liability, or I should say another type of current liability, is a warranty. Now, when we give it a warranty, there's two different types. We're going to kind of focus on the one that's going to be given when a car or an item is being sold. The other type of warranty could be if I'm, say, selling extended warranty coverage for a particular vehicle. Doug DeMuro has a great one where he bought this, I think it was like a Range Rover from CarMax for like 12 grand and then bought the warranty. And I think that CarMax ended up spending more than what he paid for the car on repairs. So if you want to see how a warranty can go wrong, that's a great example. So when a sale is made, if there is a warranty given, the company needs to recognize the warranty expense at the time of the sale, okay? The reason why is that if I'm offering a warranty, that's really a part of the cost to me of selling that product. And the amount of the warranty expense is really going to depend, and it's really going to be on our past experience. If it's a new product, what's the engineer's estimate? And what's really also important to remember is that it's not a static liability. Once I record it, that's not necessarily when I'm going to go ahead and only record that. If new evidence later comes to light in terms of a defective product, the warranty costs may need to be adjusting, such as like the cost of a recall. So again, but what we're more concerned about here today is how do we go through initially record it, and then when we have over here, say a subsequent repair, how do we go through and handle that? So our example here is on December 31st, 2019, Honest Dealer Inc., HDI, another fictional character, sold a used car for $45,000 in cash. As part of the sale, HDI gives a warranty on the vehicle for 6 months. HDI's past experience with similar vehicles indicates that HDI will have to pay 10% of the car's sales price to cover potential problems with the vehicle in the next 6 months. And then assume over here that on February 20th, 2020, HDI paid a mechanic $3,000 in vehicle repairs. So this question here is asking us to do two things. We have to do a journal entry as of December 31st, 2019, and then as of February 20th, 2020. So right over here on December 31st, 2019, Honest Dealer Inc. sold a used car for $45,000 in cash. As part of the sale, we're giving a warranty. So how do we go through and solve this? The first one I'm going to do over here is to record the warranty. I'm going to debit warranty expense for $4,500. How did I get that amount? It was a $45,000 sale price times 10%, right, to get to that $4,500. And I credit a warranty liability. Okay, so that's what I'm going to do when I sell the car. Now, what happened on February 2nd, 2020, when the cash was paid out to cover the vehicle repairs? So here, I'm going to be debiting warranty liability. I'm going to be crediting cash. So over here, I'm not debiting warranty expense. I already made an estimate of that warranty expense. Here, when I'm actually paying out cash to cover the warranty, what I'm going to be doing is I'm going to be crediting cash, and then I'm going to be debiting that liability. Okay. So let's take a look now at the really main focus of this chapter, and probably the most important thing that you need to understand, at least for my exams. So right over here, we have what we call contingent liabilities, okay? And what exactly or how do these come about? Well, companies do things. Sometimes they do bad things, right? We'd like to think that all companies do great things. We know that's just not the case, right? It's just things happen. So from time to time, a company will face lawsuits or may commit actions that will create liabilities for future payment obligations. So I pulled a few different examples here, and let's just go ahead and take a look at them. So Alphabet, which is Google, and we're going to go ahead and pull this up right over here. So when I look at the quarterly report for Google, which is Alphabet, I'm going to go over here to page 20. So over here to page 20, and actually, what page was this on? Oh, sorry, page 26. So these are the fun parts of financial statements that you get to deal with when you start working as an auditor. Okay. Contingencies, legal matters, antitrust investigations. Okay. So you see all this fun stuff here, all this disclosure. As a publicly traded company, or even as a private company, if you're being audited, what you have to go through and do is you have to essentially make an account for what we call commitments and contingencies, or can just essentially be here for legal matters. So what I'm going to do is I'm going to go ahead and put these over here. So Google or Alphabet breaks this down into antitrust, patent and intellectual property claims, and over here and other non-income taxes. So really the reason why a company needs to be doing this is that if a significant lawsuit happens and it comes out all out of the blue, and if they knew about it but didn't disclose it to their investors, remember, we are trying to create financial statements for our investors, right? So that they can make the most informed decisions. So if we're struck with a lawsuit, but we don't put it into, if we don't put this into our financial statements, we may have a problem. So if I look over here, this is an example of Google. Again, this is what we call contingent liabilities. Here is Facebook. Now with Facebook, what is interesting is that if I look over here at their general and administrative expenses, and this is really for the 9 months ended September 30, right over here, you see this $8.6 billion. Now, if I'm looking at this right here for the 3 months ended September 30th, it was only like 1.3 billion. Why would this be so much higher over the 9 months? I'd expect that this amount might be like 3.9 billion or 4 billion, or that, 1.3 times 3 for that 9 months. But when I look over here at Facebook's footnote disclosure, and I'm going to come right down here. So right over here, basically, among other matters, our settlement with the Federal Trade Commission requires us to pay a penalty of $5 billion and to significantly enhance our practices and processes for privacy compliance. So with a company like Facebook, right, this is what happens, is that they have to go through, if they're hit with a lawsuit and they know they're going to have to ultimately pay, right, that's something they have to go through and accrue for in the financial statements. And it says we have recognized the penalty and the accrued expenses and other current liabilities, our condensed balance sheet as of September 30th, 2019. So it hasn't been paid for yet, but they've actually accrued for it. Now, if you want some fun or you want to have a good time, look at the evolution of this lawsuit. You'll notice back like in April, it was based between 3 to 5, or basically I think it was for the first quarter, it was between 3 to 5 billion. Now it's at 5 billion. So this is what's really important, is that for an investor, we need to go through and tell them, hey, these are different items that we can be subject to. Over here, Johnson & Johnson. So Johnson & Johnson, do they have liabilities? And the answer is absolutely yes. They're a medical device company. We're going to see this on page 31 in just a second. And I'm just going to go close these out here. So I'm going to go over here to page 31 of this quarterly report. Right over here. And there's also, I have other videos up if you ever want to look up how to look up publicly traded companies such as Johnson & Johnson. You can find those links on some other videos that I have publicly available. So right over here, you look at product liability. Wow. And here you go. All these different things, meshes, pelvic meshes, to pronounce a voluntary recall, all these different things. So claims for personal injury have been made against Johnson & Johnson in Australia, Ethicon, all these different items down here, Johnson's baby powder, right? Everything that Johnson & Johnson is involved with. Wow, look at this. Wow, wow, wow. Look at all these different lawsuits. Wow, wow, wow. Oh my God, this is a book report. Oh my goodness, Mylan. Wow, okay. There we go. Oh my goodness. This sounds like a great, I couldn't even ask this on an intermediate accounting exam. Okay, government proceedings. We're not even done yet. Opioid litigation. Wow. Oh my goodness. Look at all these different lawsuits. General litigation. Okay. So right over here, like literally 16 pages later, we're at the end of it. So that's called going through and disclosing everything, which is something that you want to do. Remember, if you are an officer of a publicly traded company, right, or it's better to over disclose rather than failing to disclose. And again, it's just going to protect you in terms of future potential lawsuits. So with that all being said, those are huge big picture examples that I could not even, I mean, could you imagine if I gave required you to do 16 pages of footnotes for a 2-hour exam? Not going to happen. Okay, but how do we go through and evaluate contingent liabilities? So when we're looking at this, we cannot basically come up with, as an accountant, I cannot go through and determine, right? Even though I'm an accountant and an attorney, I'm not like a real litigator. That's not what I do. So what ends up happening is that the company will hire attorneys to represent them in various different corporate matters. And so what happens over here is in terms of we have to rely upon management and the company's outside counsel to determine how lawsuits or other actions against a company should be disclosing the matters in the financial statements. And another point right here is that when we are disclosing items, you have to be very, very careful to stay factual and to meet the, essentially you want to be meeting the standard. The reason is we have to be very careful about how we disclose it is because it could be used by the other party in terms of litigation against us. So when we're looking at over here though, for our purposes, okay, what we're going to be doing from a financial statement perspective is we have 6 categories. The likelihood of loss being probable, reasonably possible, or remote. And then we have 2 subcategories where we can estimate it or we cannot estimate it. The only time we are going to be going through and recording something on our financial statements is this right here. It's got to be probable and we can estimate. If we cannot estimate and it's probable, or we cannot estimate and it's reasonably possible, we are just going to go ahead and disclose in the financial statements. If something is remote, we don't do anything. So let's look at a few different examples here. So delivery truck driver crashes into a car. The attorney believes that the company will lose the lawsuit. However, the attorney is unable to estimate the dollar amount of the damages. So what would I do? So I'm going to lose the lawsuit, meaning it's probable that I'm going to have to pay something out. However, I'm unable to estimate the dollar amount of the damages. So this is probable and cannot estimate. So therefore, we're going to disclose it in the financial statements. So over here, no accounting entry, probable but cannot estimate the amount of the loss. However, the amount is going to be disclosed in the financial statements. So if you were given a question like this, what you would say is that, we had a delivery truck driver crash into a car and we're unable to, where the likelihood of us winning is not good, but we're unable to estimate the amount of the damage and therefore are not including this in the financial statements. So when you're going through though and giving like that wording or that verbiage description, this is going to be reviewed by a lot of people, the company's counsel or the SEC counsel and other people. You have to be very careful when you're doing the disclosures. Okay, let's look at another example. A former employee was not paid sales commissions. The attorney believes that the company will lose the lawsuit and will need to pay between $100,000 to $150,000 to the former employee during the year ended December 31st, 2019. Now, let me just give you a little bit of advice. When it comes to an employee leaving a company, you want to give them their full and final paycheck on that day. Why? Because if you fail to do so, that can open you up to a lot of liability. This is speaking from personal experience. I have seen an employee who was owed 10 grand. The company that had acquired the company that I was working for at the time said, I don't want to pay him. The amount of cost it ended up costing us in legal fees was close to about $100,000. So don't make that mistake. If you owe the employee money, pay him, move on. So right over here in terms of how do we go through and do this? So let's go back to the thing over here. So the attorney believes that the company will lose and will need to pay between $100 to $150. So, right, it's probable that they're going to lose. And we can estimate it. It's a range between $100,000 to $150,000. So right over here, right, I'm going to be debiting salaries expense for $150,000, crediting salaries and wages payable for $150,000. And then I'm going to go through and discuss this in the footnote. What's important to remember here is that when you're looking at this, why did I choose the higher number? It's because if I'm preparing the financial statements, right, and the attorney's giving me a range between 100 and 150, I want to book the higher number because although my financial statements may look more poorly, that is a much safer number. What happens if the amount ends up being $150,000 and I only booked $100,000? Who's going to get blamed? It'll be me as the accountant. So in this case right here, I would opt for taking the larger number, or I might go back to that attorney and tell them, hey, give me a more reasonable number. Okay, but I would always opt to use the higher number. And the reason is if it ends up being higher, or say if it ends up being 200,000, I could then go back and tell, the investors and say, hey, look, I took the higher number. And even though the payout was 200 grand, I was going with what the lawyer told me. Blame the lawyer. It's always good to do. Okay. And then this last example here, a former client sues a company for $4 million for a construction job that was completed 10 years ago. As the former client made significant modifications to the structure after the job was completed, the company's attorneys believes that the lawsuit is without merit and the chance of the company losing are remote. So over here, and this is just has to remind you of something. When there is a lawsuit, the attorneys sue everybody, right? So over here though, when I'm looking at this, for example, 3, although the amount can be estimated, right? We can estimate it, right? That's where we are right over here. The probability of the company losing is remote, right? So there's over here, my likelihood of loss is remote. So therefore, I'm going to take no action, right? And would I even disclose it in the financial statements? Probably not. I would probably just say no action. So if you're taking my class and the way that I go through, and I typically test this, at least for right now, and this is the fall of 2019, is that I will give you an example, and then I will say, what do you do? Do you record an entry? Do you do a disclosure? Or do you take no action? And then I'll say, prepare the journal entry, or tell me the disclosure, or tell me why you're not going through and recording it. So that's really what you need to remember is if you can remember this chart right here, and that we only book a journal entry if it's probable and we can estimate it, right? This is when I record it on the financial statements. If it's remote, I don't do anything. But if it's probable, but I can't estimate or reasonably possible, right? And I can estimate or cannot estimate, then I just disclose it. Remember, all this here is coming from the attorney, or it's not going to come from us, right? The attorney needs to communicate to the auditors. And one of the things that I put on a link right over here is that the PCAOB, this is the Public Company Accounting Oversight Board. And so right over here, this kind of talks about right over here is that how do we inquire with a client's attorney, basically concerning litigations, claims, and assessments. So this is something that's really important for us as auditors. But again, going back over here, this is going to be given to us by the company's attorney. In terms of going through and recording it on the financial statements, that's what we're going to be responsible for. But this is the way we want to go through and take a look at this. So I want to thank you for joining me here today. Don't forget to like and subscribe, and I look forward to seeing you on the next video. Have a great one.